Welcome to The Explainer. Okay, so if you've been paying attention to the markets lately, you know that the Federal Reserve just pulled a major move in June. They refused to cut rates. But what's really going on behind closed doors? Today, we're diving into the Fed's June secret, and more importantly, what it actually means for your portfolio right now.
So, why is the Fed refusing to cut rates? I mean, with the economy clearly showing signs of strain, why be so stubborn about this? Well, it turns out there's actually a massive, high-stakes financial mystery happening right beneath the surface. Now, the fact that they held steady wasn't exactly a shocker to Wall Street. In fact, using market data, investors predicted with a whopping 97% certainty that rates would stay put. But here's the thing. The lack of a rate cut, that's really just the cover story. The actual story is this hidden financial machine the Fed is quietly building while everyone else is fixated on the headline numbers.
Okay, so the official reason they gave for holding rates is, you guessed it, inflation. Looking at the recent lagging data, we saw an inflation spike hit 4.2%. That's the highest level we've seen in 3 years. So on paper, that absolutely justifies keeping rates elevated. The textbook says if inflation is running hot, you simply can't cut rates. But let's look at what the Fed chair actually said, because this is where things get super interesting. Take a look at this incredibly dense, classic Fed speak quote from Fed Chair Kevin Warsh. He mentioned that he, quote, refrained from offering any projections, unquote, and talked about a task force created to evaluate new information sources and consider methodological changes. I know, it sounds like absolute bureaucratic noise, right? But honestly, this is exactly where the clues to their secret machine begin.
So by refraining from those projections, what the Fed is actually doing is intentionally dropping something called forward guidance. Now, forward guidance is just the Federal Reserve's practice of telling the market what it plans to do next with interest rates. It's their playbook. By abandoning this, they are purposefully blinding the market to their next moves. Why would they do that? Well, so they don't get backed into a corner. It gives them the ultimate flexibility to just flip the script whenever they need to.
And here's exactly how they plan to flip that script. They're setting up a massive transition from old data to new data. Think of it like this. On one hand, you've got the old, lagging, survey-based data that's telling everyone inflation is stuck at 4.2%. But on the other hand, the Fed's new task force wants to roll out this real-time, AI-driven data. And guess what? This new data conveniently trims out extreme outliers, like sudden energy spikes. By fundamentally changing how they measure the economy, they're going to hand themselves the exact data-driven excuse they need to justify cutting rates, totally ignoring the old metrics.
So, how does all this build into what is basically a stealth quantitative easing machine? Well, think of it in 4 simple steps. Step 1, drop forward guidance so nobody has a clue what's coming. Step 2, change the data metrics so it artificially looks like inflation is cooling down. Step 3, give commercial banks a regulatory exemption via something called the SLR. And Step 4, let those same banks go out and buy up government treasuries. Now, let me break down that third step for you, because it's honestly the absolute linchpin of this entire operation.
SLR stands for Supplemental Leverage Ratio. It's basically a rule that was put in place after the 2008 crash to limit how much a bank can hold relative to its own money. And yes, that includes government treasury bonds. But here's the crazy industry secret. If the Fed gives banks a temporary exemption to this rule, kind of like they did back in 2020, these banks can suddenly step in and scoop up massive amounts of government bonds using huge leverage.
The pure brilliance of this setup is just wild when you think about it. Look at the difference. In official QE, the Federal Reserve directly buys bonds. But let's face it, the public is smart now. We know that looks exactly like printing money and driving up inflation. But with stealth QE, the Fed simply deregulates the banks via that SLR exemption, and the banks buy the bonds instead. It achieves the exact same goal of pumping liquidity into the bond market. But to the general public, oh, it just looks like those friendly neighborhood banks are out there lending money to Main Street.
But, of course, there's a catch. The bond market is completely rebelling against this whole secret plan. What we're seeing right now is a flattening of the yield curve. The short-term 2-year Treasury has spiked up to 4.2%, while the long-term 30-year Treasury is just sitting flat. Because the Fed dropped their forward guidance, investors are terrified of the uncertainty. They're demanding a massive risk premium on the short end to protect themselves. Basically, the market is looking right at the Fed and saying, yeah, we don't believe your data.
So what is the ultimate wrench in the Fed's carefully crafted machine? Because look, you can manipulate the data and deregulate the banks all day long, but you absolutely cannot control the global physical world. And that brings us to a rapid geopolitical collapse that's threatening the entire global economy. As our sources highlight, the US and Iran recently signed a historic peace deal,
but literally within days, the agreement completely fell apart as regional bombing involving Israel and Lebanon continued. The immediate retaliation? Shutting down the Strait of Hormuz, which entirely blocks massive global oil shipments. And you know how this works. If shipments are blocked, oil prices skyrocket. If oil skyrockets, inflation goes right back up. And boom, it completely ruins the Fed's fancy new data excuse to cut rates.
To give you an idea of just how fragile this whole situation actually is, the U.S. Strategic Petroleum Reserve only has about 4 weeks of reserves left if those ships can't move. Literally 4 weeks until a genuine, full-blown supply crisis hits the American economy. And the key takeaway here is that geopolitics isn't a light switch you can just flip on and off. Even if the conflict were magically resolved tomorrow morning, analysts estimate it's going to take 2 to 3 solid months just to normalize the 500 massive tanker ships currently stuck in the region. That means we've got months of baked-in inflationary pressure heading straight for the global economy.
So how do we actually know who's winning this massive tug-of-war between the Fed's stealth machine and global inflation? Well, here are 5 clear market signs to watch. If the Fed's plan is actually working, we should see a weaker dollar, higher stocks, lower 10-year yields, higher gold prices, and higher Bitcoin prices. But right now, following that June meeting, the market is flashing the exact opposite on all 5 of these indicators. So yeah, the plan is currently failing.
Now, it's one thing to talk about trillions in stealth QE and global oil shocks on a giant macro level, right? But what does this actually mean for your wallet? The brutal reality is that all this turbulence, the high interest rates, persistent inflation, global uncertainty, it's quietly devastating the everyday American portfolio.
Just look at this number. This is the shocking reality we're dealing with. The U.S. personal savings rate has completely collapsed down to a measly 2.6%. To put that into perspective for you, that is the lowest it has been since right before the 2008 Great Financial Crisis. People's incomes are literally just being squeezed dry by the insanely elevated cost of living.
And because savings are so incredibly depleted right now, people are turning to desperate measures. A record 6% of participants are currently taking hardship withdrawals from their 401ks. Think about that. They're eating massive tax penalties and literally borrowing from their own future just to survive the present. And honestly, this exposes a massive lie we see all the time in financial headlines. You might read that the average 401k balance is a pretty healthy $167,000, but that average is heavily skewed by a tiny percentage of the ultra-wealthy. If we look at the median balance, the exact middle, representing the typical American, it's only $44,000. This perfectly illustrates this stark K-shaped economy we're in, where the typical worker is just severely underprepared for retirement. So with the Fed playing games with the data and inflation basically eating your savings for breakfast, how do you actually shield your portfolio? Well, here is your trusted survival guide based on the numbers. First, always take the employer 401k match. It's literally free money. Second, use auto-escalation to automatically bump up your contributions by just 1% every year. Third, if you're over 50, make sure to max out those IRS catch-up contributions. And finally, relentlessly watch out for high fund fees. Seriously, an actively managed fund charging close to 1% can rob you of tens of thousands of dollars over a few decades.
But above all else, the most fundamental rule I want you to take away from this explainer is simply this: don't panic. Stay consistent. The biggest winners in finance aren't the guys trying to day trade the daily geopolitical news or time the Fed's hidden stealth QE machine. No way. The real winners are the ones who set up a rock-solid, automated investment process, keep their emotions in check, and entirely ignore all the daily noise.
Which leaves us with this final thought to ponder. Will the Fed's data-driven stealth QE save the bond market, or will global inflation crack the machine before it even starts? We're literally watching a real-time collision between a central bank desperate to engineer a soft landing and a chaotic global supply chain that's threatening to blow the whole thing up. So keep a really close eye on the data and definitely make sure your portfolio is braced for impact. Thanks so much for joining me for this explainer, and stay curious.